We've all heard it, Amazon didn't pay any taxes in 2018 on a record profit. But how is it possible that a company that was briefly the largest in the world in 2018 isn't paying their fair share of taxes? In our previous video, we talked a little bit about Amazon's quest for strategic dominance. However, what many don't realize is that Amazon's growth strategy in many ways hinges on how they operate within the framework of the US tax system. To explore this idea further, I want to investigate Amazon's tax situation in 2018. This will help us better understand the incentives within our tax system, and then we can compare what Amazon's been doing with others. This can tell us why they've been operating under their chosen strategy, and some of the loopholes the government could look into closing. One area that's out of corporations' control is the federal tax rate, but that's the first area where Amazon saw relief in 2018. If you remember, in 2017, Congress enacted President Trump's Tax Cuts and Jobs Act, which cut corporate tax rates from 35% to 21%, further reducing the taxes Amazon already had to pay. The US tax system has several incentives for businesses deemed to be helpful for the long-term well-being of the economy. So let's go over those tax incentives with an eye on the ones most relevant to Amazon. First up, there's the research and development incentive. Companies have to meet a variety of requirements to qualify here, and Amazon has consistently met those criteria while spending 40% more than any other company in R&D. Then there's the employee incentive. These are incentives aimed to encourage hiring and retaining employees. Here's Amazon on the list of companies with the most employees. Amazon ranks second here. Next, there's the training incentives, which are given to companies for helping their employees improve their overall skill level. Amazon has a large-scale career choice program, paying up to $12,000 per employee through 4 years of schooling. So safe to say they checked this one off as well, especially given the sheer number of employees they have. And then there's discretionary incentives, which is an obvious one for Amazon. We just went through a year-long circus to determine their new headquarters in Virginia and New York, which they later scrapped. And finally, there's property incentives. Between their warehouses, data centers, and physical stores now, Amazon is probably the most capital-intensive software company and easily checks this box off as well. And then aside from these more common tax incentives, Amazon also benefits from tax credits related to stock-based compensation. In 1993, Bill Clinton signed a law stating that corporations could not deduct taxes for executives making over $1 million in order to discourage overpaying them. Well, it didn't work. Companies now use stock options to pay executives under the claim that it counts as performance-based pay, meaning it is actually tax deductible. On over $5 billion handed out in stock-based compensation in 2018, Amazon received $1 billion back in tax credits related to this. But tax incentives are meant to elicit good behavior from our corporations. Now, are there loopholes? Absolutely. But for the most part, Amazon has just been playing the game, like every other corporation. What separates them is their unique capital allocation strategy. See, President Trump's 2017 tax cuts led to a record level in corporate share buybacks, crossing the $800 billion mark. Basically, corporations decided they were better off buying back their own stock in an expensive market rather than reinvesting into their own business. Here's Warren Buffett's business partner, Charlie Munger, on the concept of share buybacks.
I will say this. When it was a very good idea for companies to buy back their stock, they didn't do very much. And when the stocks got so high priced that it's frequently a bad idea, they're doing a lot. Welcome to adult life.
But Amazon didn't even consider this strategy. Instead, they continue finding innovative ways of putting their cash to work. Why? Because it's in the DNA of the company Jeff Bezos built.
Day 2 is stasis, followed by irrelevance, followed by excruciating, painful decline, followed by death. And that is why it is always day 1.
So Amazon's model is think like a startup, work like a startup, and I'll throw in one more. Tell your story like a startup.
Keep it simple and keep it focused. What's the end game for every business? You have to show me a pathway to making money. Pathway doesn't have to be next year. It might be 7 years from now. So don't keep talking about how many users you have. That's nice. Tell me how you plan to convert these users into profits.
Consistent storytelling to their investors has not only allowed Amazon to raise their stock price for years without profits, but it has also knocked off billions of dollars of market value from companies in competing industries. It was always about exponential growth for Amazon, and to sell exponential growth to a world of linear thinkers, Amazon needed Bezos' storytelling capabilities and precise execution. Bezos built Amazon on the back of a powerful subscription business. The key to understanding a subscription business is to think of it like a contract between you and the business that you can opt out of at any time. So what matters for the business and its relationship with you is the lifetime value of that contract. How long have you held a relationship with the business, and what's that relationship worth? A strong subscription business delays profits. If Amazon's able to keep customer acquisition costs low and retention rates high, they'll keep adding customers over the long run, which leads to enormous profits down the line. To dig deeper into this concept, we'll introduce John Malone. In Malone's time as CEO of TCI, he was laser focused on wealth creation. He believed it wasn't about earnings in the short term, because if you had earnings in a subscription business, it means you're not really growing. The most important factor to him was tax-sheltered cash flow growth that was growing faster than the interest rate at which you could borrow money. Amazon understood this and felt that to the extent that you can borrow money and invest back into the company, you should. Deferring taxes allows the value of shares to compound pre-tax. Charlie Munger notes, if something compounds for 30 years at 15% and it's taxed 35% after the 30 years are over, you still grew 13.3% annualized. Contrarily, if you were taxed every year at the same rate, you're only growing 9.75% despite being taxed on smaller sums each year. That 3.55% can mean billions of dollars over time for Amazon, which they then use to reinvest and strengthen their competitive advantage. One avenue they discovered that competitors would be unable to match in the long run is the bundling strategy. With Prime, Amazon has been able to structure an ecosystem to get consumers to pay for multiple things they're not even sure they want due to convenience. Think about it, split out, would you pay for Amazon Prime and Prime Video separately? Probably not. But over time, whether you like it or not, you are paying for both. Yes, you might be getting a good deal if you use all of their services extensively, but most people don't. The idea behind the bundle concept is to increase revenue per customer while marketing the attractiveness of the bundle to non-customers. If done right, this leads to enormous scale and pricing power, which Amazon has exercised over time. And this is a virtuous cycle. Diversify the value of the bundle to keep customers locked in, expand overall market share, and raise prices at the perfect time to pay for the excess cost generated. Every company goes through a life cycle, and in Amazon's case, they're showing signs of maturing already, as profits are becoming a larger percentage of their revenue. As this happens, taxes will grow too. It's inevitable. Their strategy is no longer a secret to other companies. But becoming Amazon has a lot to do with the details and holding a long-term view, two of the hardest things to get right. To disrupt Amazon, it'll likely take a total shift in the reality of technological circumstances. But that reality probably isn't coming anytime soon. And even if it does, Amazon is still uniquely positioned for it. Thank you for watching. If you liked this video, you can help us reach more people by hitting that like button. Also hit the subscribe button for more content like this.